Good evening and welcome to tonight's Buzz lesson on taxation of business structures. You are here with Gemma and tonight we'll be discussing the definition of small business for small business concessions, this including aggregated turnover and various aggregated turnover tests. In short, the small business concession allows a small business to transfer its assets or valuables in simple terms without triggering a tax liability from one entity to another entity that is related. It is important to note that the government introduced these concessions to assist small businesses with their tax liabilities. Firstly, you need to consider whether something is a small business entity. This includes whether or not they are carrying on a business and have an aggregated turnover of less than $10 million. What is an aggregated turnover, you ask? Well, ITA 1997 section 328.115 has got you covered, but for now I'll explain. An aggregated turnover for the income year, which I'll have you know is different to the standard calendar year, is from the 1st of July to the 30th of June. This is the sum of relevant annual turnovers for the small business, the capital gains tax relief purposes. Additional entities may be treated as being connected with you or your affiliate listed under sections 15248 and 15278. The Australian Taxation Office further advises that aggregated turnover is your annual turnover, otherwise known as income, additional with any other income for businesses connected with you, and that is your affiliate. This is also including any relevant businesses based not only in Australia, but overseas too. What a nightmare, you're thinking, but don't worry, there are ways to work it out. Back to it then. To consider and evaluate whether certain income is included in the aggregated turnover, there are two things to think about, this including control tests and influence. Control testing is having 40% control over an entity. This is different for each and every entity. For partnerships, they must receive at least 40% of net income of a partnership. A company, on the other hand, needs to own at least 40% entitlements in income or voting rights, and a unit trust is 40% of the entitlements under income, capital, or distributions. With regards to influence, this relates to acting accordingly to the interests of that connecting entity. For example, say our mate Josh owns 40% in his friend Johnny's company. You are considered to be partially in control. Therefore, this will be included in Josh's aggregated turnover. Make sense? You keeping up? Now, there are three different methods in relation to aggregated turnovers for small business entities. These include the following. The first method is the previous year method, or otherwise known as the look back year. In order to use this method, you must have an income of less than $10 million to be classified as a small business entity in the current year. The second method is the estimated year method, or otherwise known as the look forward method. This method again requires the aggregated turnover to be less than $10 million. However, there are eligibility rules applied, including that one of the two previous years' aggregated turnovers must be less than $10 million. Otherwise, this method cannot be used. And finally, the third method, which is the most common, is the actual current year method. Within this method, if the aggregated turnover is less than $10 million at the end of the year, it is classified as a small business entity for the current year. Going back to Josh, if out of his income for the past 2 years, one of them was under $10 million, he can use the estimated current year method. Now, there are quite a few available concessions, which I'll put on the screen now. For the small business entities, have a threshold of $10 million. Majority of them, have a threshold of $10 million. However, two of them, this including small business CGT, has a threshold of $2 million, and small business income tax offset has a threshold of $5 million. One of these concessions is the simplified trading stock rules, which advises that if there is less than $5,000 between the value of stock on hand at the beginning of the year and a reasonable estimate of the value of stock at the hand at the end of the year, then there is no need to complete a stock take. How good is that? Back to our mate Josh, if he wouldn't have to pay his bookkeeping lady Jill an additional amount of money to complete stock take. Better yet, there is no need to account for changing the value of stock. However, if Josh chooses not to accept this concession, then Jill will have to complete a stock take. Another concession is the simpler depreciation rule. This includes if you have an asset that hasn't costed you more than $150,000, an arm or a leg, then you can claim it as an immediate deduction. So back to Josh. If he bought a machine for less than $150,000 for his company, he can claim this as immediate deduction. You can see a list on the screen here of all other available concessions. We've run out of time to go through the rest tonight, so please do a little research in your own time and learn the available concessions for small business concessions. I hope you have enjoyed tonight's Buzz lesson, and we hope to see you next week, where we'll be discussing the overview of small business tax discount. Please also see a list of my references on the screen. Thank you and have a good night.